I view the labor market as having deteriorated. It's just not appropriate to be restricted to this degree. For us to remain this degree of restrictive means that we're running unnecessary risk of inducing a slowdown in the economy and a downturn in the labor market. So I do think cutting rates is the right move. I do expect us to cut rates further. I would prefer to get to neutral at a faster clip.
The Federal Reserve is at a crossroads headed into 2026, with 2 voting members of the Fed's Federal Open Market Committee dissenting in its recent October meeting. Investors are very uncertain about whether the Fed will pause or carry on cutting interest rates in its upcoming December meeting. I'm joined by Fed Governor Miran today, who since his appointment in September by President Trump has dissented in 2 consecutive Fed meetings, preferring to cut by 50 basis points instead of 25. I want to know what is driving his case to cut rates with such scale and speed. Is it fear of a recession, a labor market slowdown, tariffs? Why the rush? Also, with the funding markets, which rely on Fed reserves, showing signs of stress, I'm going to ask about the Fed's balance sheet. We'll see what he says. Today's episode is brought to you by VanEck's Rare Earth and Strategic Metals ETF, ticker REMX. Later in the show, you'll hear about the growing investment opportunity behind rare earths and why these materials are crucial to everything from smartphones to defense. Let's get into it. I am joined today by Governor Stephen Miran, member of the Federal Reserve Board of Governors. Governor Miran, thank you so much for joining us here today. Welcome to Monetary Matters.
Hey, Jack, great to see you. Thanks for having me back.
Governor Miran, you have dissented twice in 2 consecutive Federal Open Market Committee meetings, opting to or preferring to cut by 50 basis points instead of 25 basis points. I know the December Fed meeting is very uncertain, and we're going to get into your outlook on that, what is preferable and what is likely for the December Federal Reserve meeting. We're going to get to that later on, as well as the Federal Reserve's balance sheet. But I want to start out by asking you to explain what is your theoretical framework for being so dovish, for estimating that interest rates should be close to 200 basis points or 150 to 200 basis points lower where they are right now. Why do you think that?
Sure. So I guess, look, there's really three things that go into thinking about where monetary policy should be. There could be more, but most people think about 3 things, the 3 inputs, what we would call a policy rule or a Taylor type of rule. And those are the outlook for inflation, the outlook for the labor market or the output gap, and where policy ought to be relative to some measure of neutral as a way of sort of quantifying whether policy is restrictive or accommodative, and then thinking about how restrictive or how accommodative it should be. And when I go through those 3 items, I come to a conclusion that policy should be much closer to a neutral setting. So let's take them one at a time. Inflation has been running higher than it ought to be, higher than the Fed's target for a while. However, I think a lot of that is quite backward looking. And so, for example, one of the largest components of these inflation indices, something like shelter, is extremely backward looking in the way that it's compiled in the inflation data. And so the way that inflation measures shelter costs, rents, owner's equivalent rent, is based on when you renew your lease or when you move and get a new lease, and sort of and imputing a sort of similar change in housing costs to owners who are occupying owner occupied housing. And that will necessarily lag where the market is. And so if you go and you look at where rents in the market are, and you go and look on Zillow or some other provider of rents, or you go to sign a lease today, it'll show you that new leases have been growing at a very low rate. If you look at a national change in new rents, whether you're looking at the BLS's new rents index, or you're looking at a weighted average based on single and multifamily of Zillow and apartment list, it'll tell you that rents are moving at about a 1% annual rate, which is quite low and quite a bit below where they were moving, where they were inflating pre-pandemic. Now, the shelter inflation that gets recorded in the official data are running materially higher than that. And the reason is that those data are quite backward looking because they only update when you reset your lease. Most people don't reset their lease every day, every month. It happens once a year. It could happen 6 months from now, or maybe you have a longer term lease. It happens 2 years from now. And so the fact that the inflation data wait to record the increase in the lease until the lease is actually reset means that the official data lag quite a ways behind where the market is running. Now, for a long time, there was a lot of questions about how long it would take that to catch up to the market rent data. However, numerous indications to me are that the catch-up period is over, and that therefore the period of convergence of the measured rent inflation down to where the market is ought to be happening now and ought to be happening quite quickly. And I think we started to see that over the course of the year, and we saw it pick up in the September CPI data that were just recently released. Now, another element that I think is going to be weighing on shelter inflation is the change in population growth. So we've gone from having a very dramatic increase in population growth over the previous years as immigration really picked up aggressively. And of course, if you throw lots of new residents into a relatively fixed supply of housing, you're going to put upward pressure on shelter. That caused a material amount of inflation in my mind through the shelter channel. That's reversed now. Population growth has declined because net migration has gone down to zero, potentially even negative, as the government has been actually sending a number of migrants home. You get fewer people occupying, again, the relatively fixed supply and only slowly growing supply of shelter, and that removes inflationary pressure from the housing market. And so when I look at inflation, I see some too high inflation. I see it as being somewhat backward looking and sort of not really encompassing the disinflation that I expect to come from the future in inflation. I see other elements of the inflation data being driven by elements that are not real prices that are paid by households. And so you think about things like imputed prices in items like services outside of housing and things like portfolio management fees, things like financial services. Those end up getting mechanically boosted by increases in the stock market. And the way that this works, the way this is recorded in inflation, is if the stock market moves higher, then portfolio management fees move up because the base on which they're calculated increases as well. And that gets recorded as inflation. Now, taken literally, that would have the Fed literally hike rates in response to the stock market moving higher. But of course, there's many reasons the stock market can move higher that have nothing to do with monetary policy. It could move higher because of a new technology that's invented. It could move higher because of a change in tax policy. And the idea that monetary policy should mechanically offset that because of the way that it's calculated in the inflation data is a little bit far-fetched to me. When you look at the services outside of housing that are not a result of imputed prices, that are a result of market-based prices, you see inflation rates that are much closer to 2.3, 2.4%, depending on what frequency you're measuring them. And so I view a large portion of the inflation that we have as backward looking. I view a large portion of it as being somewhat phantom in the sense that it reflects imputed prices and not prices that households are actually observing. And so I'm actually a little bit more sanguine on the inflation outlook going forward than some of my colleagues are as a result of that. I also see the labor market as having weakened somewhat over the course of the year and weakening more recently, and we can get into that a bit. And then there's finally the element of the neutral rate, of how restrictive is policy. And I view that as having whipped around a lot faster than some of my colleagues have. I viewed the neutral rate as having been pushed up last year by a number of policies and phenomena like AI as well. And then this year, a number of changes have occurred which have pushed the neutral rate back down. And that's caused some passive tightening of monetary policy over the course of the year. So I throw all of these things together, and I see the appropriate rate of Fed funds of policy rates as being a lot closer to what we think of as neutral than a lot of my colleagues do. And I just don't see a point of getting there slowly.
Thank you to Governor Miran. So you think that rental inflation is running at a lower number than the official numbers. So that is in the inflation world. But when it comes to the neutral rate of interest, or the estimated rate at which interest rate policy from the Federal Reserve is neither expansionary nor contractionary, or I guess one way to think about it is the interest rate that the economy can handle. You estimate that interest rate has gone down, and gone down by a lot, over 100 basis points. Just why is the neutral rate, R star, so much lower than last year?
So I think the calculations that I did indicated that the neutral rate had declined by about 1.25 points. Now, if you look at where I was last year, it's the case that I was at the top of the range of where everyone else in the committee was last year. If you look at where I am this year, it's the case that I'm at the bottom of the range where everyone else in the committee is this year. So in neither case was I think I necessarily outside of the range of where everyone else was. I think I was at the ends. Where I differ from a lot of my colleagues is the speed with which I think neutral moved. And part of the reason why I differ on the speed is because the drivers of neutral have moved much more quickly than they historically have. And so normally we think of neutral as moving only very, very slowly as changes in the economy occur very, very slowly. And so, for example, one of the most important drivers of the neutral rate is population growth. If you have a fast growing population, there's lots of investment that you need to do. People need to build houses, they need to build roads, they need to build schools and hospitals. And that need for a lot of investment drives what we think of as the neutral rate higher. If you have a much slower growth of population, or you have stagnant population or declining population, that's going to pull the neutral rate down because you don't need to invest in those things. Now, normally population growth changes very, very slowly over time with slow changing differences in culture and medical technology that lead people to have fewer children over, declining population growth rates over time. But in the last few years, that's not the case. Population growth moved extremely quickly. We experienced bigger changes to population growth in the last 3 years than we'd experienced in the last 30 years. And that happened in both directions. And so it stands to reason to me that the neutral rate, which historically may have moved very slowly, and therefore it's an acceptable practice to sort of think that you're going to know neutral based on evolution in the economy. Policy is relatively calm and it seems like inflation is really picking up or the economy is really heating up, maybe you think that neutral moved higher. And so normally you'd think of knowing neutral by its works, you'd think of observing its effect in the economy. However, in my opinion, in this case, we can't take that approach because we know that the drivers of neutral moved much more quickly than they historically did. We know roughly the size of these shocks. We know the effect they had on the economy. And so therefore, in my opinion, it makes sense to think of neutral as potentially moving around more quickly than it normally would.
And that massive population change that you described has roughly you estimate a 36 basis point decline in the neutral interest rate. Almost twice the effect is in trade policy. So many economists, Governor Miran, estimate that President Trump's tariffs is going to lead to inflation or at least a one-time price shock that may or may not lead to a sustainable rise in the price level, aka inflation. You are actually estimating that the Trump administration's trade policy is going to lead to a decline in the neutral rate and a quite sharp one. Can you explain your logic here?
So neutral, broadly speaking, is the rate at which monetary policy is neither restricted nor accommodative. And if you're below neutral, then you're sort of putting stimulus into the economy, and if you're above neutral, you're putting the brakes on the economy. Now, the driver of neutral rate at the end of the day is the supply-demand balance of loanable funds. If there's a huge demand for investment in the economy and not a lot of savings, that's going to drive neutral higher. If there's a huge supply of savings, not a lot of demand for investment, that's going to drive neutral lower. And that's what people, generally speaking, before the pandemic referred to as so-called secular stagnation. Or it's a driver. It was a driver of that. Now, when I think about tax policy, right, I think of a couple of things. I think of effects on productivity growth and organization of the supply side. I think of effects on investment, and those can potentially both push neutral rates higher. And I analyzed both of those in the speech I gave at the Economic Club of New York last month. But there's another effect that pushes R star lower, and that's increases in national savings. And when I did the numbers, I found the increases in national savings actually ended up pushing R star further down than the increases from the other effects. And the reason that happens is because when you save more relative to the amount that you're investing, that's going to naturally put downward pressure on interest rates across the curve in a way such that if the Federal Reserve doesn't offset that, it's going to be contractionary for the economy. Now, that increase in national savings is coming from a couple of sources. It's coming from increased tariff revenue. The Congressional Budget Office estimated almost $4 trillion of decreased fiscal deficits due to tariffs over a 10-year budget window. That's well over a point of GDP per year, so that's a very material swing. And then there's other increases in national savings also. I expect better economic growth to reduce fiscal deficits as well through a similar channel. And again, I don't think it's not controversial to understand that better economic growth is going to reduce fiscal deficits because you have more revenue. The revenues grow faster than the outlays do when you have stronger economic growth, and so that's going to also put downward pressure on the neutral rate, in my opinion. And so what I did in that earlier speech was to sort of put numbers to all of these things and then to add them up. And some things push neutral higher, some things push them lower. I found that when I added across all these categories, that neutral was actually pushed quite a bit lower.
And so the tariffs, which increase tariff revenue, which gives money to the government, that will lead to an increase in national savings, which will drive the neutral rate of interest lower. How do you think about the One Big Beautiful Bill passed in Congress? And it has some measures that do raise revenue with cuts, but a lot of, I believe, tax cuts. Do you think those tax cuts will decrease national saving and moderate R star higher?
I think that a lot of the conversation about the tax bill earlier this year depended on your choice of baseline. And if you used what people called a current law baseline, then it did look like there were over some time horizons increases in the deficit because the current law implied a massive tax hike, right? If the tax cuts from the 2017 Tax Cuts and Jobs Act had expired, it would have been the largest tax hike in U.S. history. And so, of course, on some analyses, that ended up looking like a material tax cut on a current law basis. But from a monetary policy perspective, we need to be thinking about these things on a current policy basis. And on a current policy basis, the increase in the deficit as a result from the One Big Beautiful Bill, in what economists call a static sense, I think is quite limited. And in what economists call a dynamic sense, which means that you allow for improved economic growth as a result of the provisions of the law, I think it actually is going to end up decreasing the deficit through improved economic growth, as I said before. Now, if economic growth improves by a percentage point, that reduces the deficit by, I think, almost $4 trillion over a decade. Because revenues are going to grow faster than outlays, and I think there's actually some quite powerful supply side provisions that have been enacted. I think that the evidence from people studying the 2017 Tax Cuts and Jobs Act was that the full expensing provisions were actually the best bang for the buck in terms of incentivizing investment. So I do think that there's going to be a significant growth response a significant growth effect in response to the supply side incentives that have been created. And that's going to, over time, put downward pressure on the deficit, which actually ends up increasing national savings.
Thank you for explaining that. So we're recording in November. The next Federal Reserve meeting is December 9th and 10th. In the October meeting, Fed Chair Powell, when questioned about whether the Fed is going to cut in December, said that an interest rate cut is not a foregone conclusion and far from it. He used that language, which it doesn't sound like extreme language at all, but for the Federal Reserve, it is somewhat forceful language, I might say. And that did surprise interest rate markets as well. They were pricing in a cut in December, and the dot plot from September showed that many FOMC members were also expecting an interest rate cut. Certainly, you thought that a 50 basis point cut would be appropriate, and another one in December. How are you thinking about December, both in terms of what you think is optimal based on your framework, how you're reading the economy, but also based off the other Federal Open Market Committee members?
That's a great question. Look, I expect us to cut in December unless there's some sort of surprise. And I guess the reason I would say is as follows. When the chairman speaks, he's representing, to an extent, the range of views around the table. And there absolutely was a wide range of views around the table, as you can see reflected in the fact that I dissented for a bigger interest rate cut, and one of my colleagues, President Schmidt, dissented for no cut at all. And so that is emblematic of differing opinions. Now, I think differing opinions are healthy. I think that groupthink can lead to insufficient examination of premises and preconditions and assumptions. That can sort of prevent you from getting to the right answer more quickly. And so I think a wide variety of views is actually quite healthy. But when you look at the distribution of votes around the table, it's different than the distribution of views. And so for that reason, I would expect, based on current information, that we end up cutting in December, but nothing is absolutely guaranteed. At the end of the day, former Speaker of the House, Nancy Pelosi, had it right when one of her favorite sayings that she would repeat often is that in Washington, the vote is the currency of the realm. And I think that's going to apply here too at the end of the day. But of course, there could be new information between now and the December meeting. We haven't gotten economic data in a while. We're missing a lot of economic data. We're hoping that we get that economic data in time for the next meeting. We're making do with some alternative data in the meantime, but we're definitely impaired in our analytic capabilities relative to how we would be in normal times. And so, there's always the scope for new information. But at the moment, my expectation would be that we end up cutting. I think it's the right choice. I think it's the right policy decision. And so I think that we'll end up doing the right thing.
So you think that another 25 basis point cut will happen in December, barring some exogenous shock or the like. But do you think that a 50 basis point cut would be appropriate?
Look, as I said before, my view is that we should be closer to neutral based on the outlook for the labor market, based on the outlook for inflation, based on the decrease in the neutral rate that's occurred over this year. I don't see a point in us remaining restrictive. For us to remain this degree of restrictive means that we're running unnecessary risk of inducing a slowdown in the economy and a downturn in the labor market. And I don't see the point of running that risk given the outlook for inflation and the fact that shelter is disinflating materially. And a lot of the inflation that we see is A, backward looking, and B, some of the rest of it is phantom in the sense of being a result of the imputed prices that we mentioned earlier, things like portfolio management fees. When you look at market-based core inflation, it's lower. When you look at market-based core services, other than housing, which is a bit of a special case, it's also much lower. And so underlying inflation is lower. It's just not appropriate to be restricted to this degree. So I do think cutting rates is the right move. I do expect us to cut rates further. I would prefer to get to neutral at a faster clip. However, I think, as you can tell from the votes, a lot of my colleagues would prefer to get there in 25 basis point clips.
Thank you. Governor, and I'm going to explain something and use some assumptions. So if my assumptions are incorrect, please correct me. But in your September 22nd speech, when the interest rates was 4.09%, you said that you judged the appropriate level of interest rates to be almost 200 basis points lower than that. So even conservatively saying that's 175 basis points lower than that, that would be 2.34%. And then I looked at the September dot plot, and the lowest level of interest rates I could see was in 2027, which was 2.4%. So even the lowest dot in 2026 is 2.6%. I assume the lowest dots, is you. Please correct me if that is wrong as well. But why do you think that it would be appropriate to wait over 2 years to have the Federal Reserve cut interest rates to a level that you think would be appropriate?
So you're right. There is a little bit of a divergence between the speech that I gave and what I wrote down in the summary of economic projections and the dots. It's a result of the timing forces of when the various factors kick in. They don't all kick in at once. Some of them kick in gradually over time as the effects of, for instance, the tax bill that we were talking about before kick in. They don't all kick in immediately. Some of those effects phase in over time in terms of the economic response to them. The economy doesn't respond instantaneously to every single policy change or every single shock that hits it. It takes time to work its way through the system. And that means that when you sort of actually go to writing down dots over time, it means that you don't automatically get all the way to where you want to be overnight. It takes some time for that to phase in. Now, in the speech was long enough as it was without getting into those issues of timing. And so I basically ignored the time dimension in the speech and collapsed everything down to do a moment in time. There is a bit of a difference though, and there always was. I think I may even have had a footnote in the speech about that difference and sort of the fact that some of those factors kicked in gradually over time. But that's what's driving the divergence there.
That makes sense. And so you were the bottom dots of 2.6% for 2026 and 2.4% for 2027.
Yeah.
Governor Miran, based on the 25 basis points cuts that we've done in September and then in October, you want to do 50 basis points at both. So we're at least 25 basis points behind, maybe 50 basis points behind. Previously, you had said that you favor 50 basis points cut as a nice even clip. You don't want to get too extreme, not do a 75 basis points cut. But if the Federal Reserve is as behind as maybe you think it is, at what point would it become appropriate to do a 75 basis point cut in December?
So look, the fundamental core of my view is that we're restrictive. We're running risks that we don't need to be running about the labor market, that inflation is on the right track. And as a result, it's appropriate to get to neutral more quickly. I don't want to signal that I'm panicking. I don't want to signal that there's something really out there to be excessively concerned about. The core of the view is not that I think that there's a significant downturn around the corner. It's that we're running risks that we don't need to be running. And as a result of that, we can move to neutral at a relatively quick clip of 50 basis point cuts. It's not the case, I think, that we need to sort of move more quickly than that. And the fact that I didn't necessarily get exactly my way in the last two meetings doesn't mean that I think we need to accelerate. I think it means that we need to just continue getting there as quickly as feasible into the neighborhood. And at that point, we can sort of then slow down and reevaluate and look around and see what the right move is for the next time. I don't feel the need to make up for lost ground. It's only been a couple of meetings. You could sort of imagine that if we were a year late, or materially later than we have been thus far. There might be arguments for moving even faster, but I think that we're a bit far from that place.
So some people may look at your very dovish outlook and say, oh, Governor Miran, his level of concern about a slowdown or a recession is high or very high. You're saying that it's not that your concern is very high. It's just that your level of concern about inflation risk is quite low. And as a result, even though your concern about a slowdown is only moderate, it's appropriate to cut interest rates to meet that risk.
Yeah, look, I don't view inflation risk as being very material to the upside, given all the dynamics that we discussed before. I view the labor market as having deteriorated last year, continued to deteriorate this year. Doesn't appear at the moment that it's really accelerating in deterioration. It just appears to be continuing, sort of continuing gradual on the gradual course that it has been. And policy is still quite restrictive. That's not a combination that indicates the combination of inflation and labor market outlook do not indicate the need for materially restrictive policy. They indicate the need for policy that's much closer to neutral. And so as long as we remain as restrictive as we are running the risk that we actually do end up causing a much more material downturn in the economy than we forecast. We run the risk that policy itself induces that. Now, it's critical to understand that monetary policy works with famously long and variable lags. And while my view is that the neutral policy rate has moved down over the course of the year, meaning that the effective amount of restriction being provided has increased gradually over the course of the year, it's not the case that we would necessarily expect to see those effects immediately, because monetary policy works with long and variable lags. But if you remained this restrictive for a long period of time, then those lags can work their way through the system. And that's when you sort of expect that you would see the effects in the economy and then experience a sharper downturn in the labor market.
How concerned are you about the labor market? What are the various indicators you've been looking at to point to a softness? Fed Chair Powell has used that word softness many times in reference to the labor market. I don't think he's used the word weakness that often. Would you use that word weakness? And also, how are you thinking about the data, given that we have a government shutdown, so we're not getting the official data?
So the alternative data in the labor market are not a substitute for the official data, but they're still useful in the absence of the official data. And we've been getting data that corroborate the story that I told before, which is one in which labor demand appears to be weakening. If labor supply were weakening more than labor demand, you would expect to see upward pressure on wages. You would expect to see people reporting that it's easy to find jobs. You would expect to see firms reporting that it's difficult to find workers, and you don't see that. You see continued wage moderation. You see confidence surveys showing decline ease of finding new jobs, and you see surveys of small business employers saying, declining difficulty of filling positions. As a result, it's indicative that labor demand has been declining quicker than labor supply with the change in border policy. As a result, it's indication that policy is quite restrictive and having an effect on the labor market in the way that it always does. And it indicates that policy does not need to be as restrictive as it is, that the labor market is on the course that it has been for the last couple of years, and it's time to alleviate that amount of policy restriction, given how benign the inflation outlook is.
Hope you're enjoying today's interview. Rare earth metals are the hidden backbone of modern technology and defense. They power everything from smartphones and electric vehicles to wind turbines and fighter jets. Countries around the world are racing to build their own secure supply chains, driving investment focus into the companies best positioned to reshape this sector. Investors can gain exposure to these critical materials through the VanEck Rare Earth and Strategic Metals ETF, ticker REMX. Go to vaneck.com/REMXJack to learn more. That's vaneck.com/REMXJack. Now back to the interview. In recent interviews, Governor Miran, you've noted a tone of caution with regards to private credit. What is your concerns about private credit, the several bankruptcies and issues that have happened over the past month and a half? And also, is there something special about private credit that is of a different concern than if it was in the banking system?
Sure. So I actually don't have, I would say, very exceptional concerns about private credit in itself. In general, look, there's a whole regulatory conversation to be had about whether credit should be allocated for regulatory arbitrage reasons as opposed to sort of fundamental market reasons, but that's sort of a separate issue. What sort of caught my eye about private credit recently has been a couple things. One, it's been a seemingly uncorrelated series of credit events that sort of have some common features that have all come to light at the same time, and they seem to be unrelated. However, we know from past experience that seemingly uncorrelated credit events can be an indication that monetary policy is restrictive or too restrictive. And it could be the common factor that's driving things like that, as has happened at various previous points in economic financial history. The other thing that sort of caught my eye about it is thinking about sort of one criticism that I often receive is that I say that policy is quite restrictive, and people say, okay, but financial conditions are so loose. To me, that argument doesn't hold water for a couple reasons. One, when you sort of look at it, it depends what financial conditions you're looking at. If you look at the housing market, for instance, conditions are anything but loose. Sort of, I think conditions in housing finance and housing markets are still extremely tight, and those are arguably economically the most significant financial conditions to be considering. I also think that financial conditions are affected by a wide variety of things that have nothing to do with monetary policy. Things like AI, things like tax policy, things like government regulatory policy and energy policy and geopolitics and geopolitical risk premia. There's any number of things that could be affecting financial conditions that just have nothing to do with monetary policy. And it's inappropriate to ascribe all financial conditions outcomes to monetary policy. But the thing about private credit that piqued my interest is about whether we're observing financial conditions in a holistic sense because of the growth of private credit. And when you look at the share of credit growth that's occurred in private markets in the last 4 or 5 years or so, it's been substantial. It's been very substantial. It's been a very substantial driver of credit growth. And if there's weakness in that sector, then a couple things come to mind. One, is it the case that the financial conditions that we're looking at are really reflective of the economy as a whole, because they tend to overwhelmingly focus on public markets because they have marks and can be given daily, sort of daily spreads and things like that in the way that works itself into a financial condition index. The other thing that seems of interest to me is if that's the place where a lot of credit creation has occurred in previous years, and it's starting to slow down, then what does it tell us about the stance of monetary policy? And finally, it's if that's the place where a lot of credit creation has occurred, what does that say about the availability of credit and who the borrowers are in the other segments of the indices? And so I don't have any really firm conclusions on this. All I have are a bunch of questions, but questions that I'm looking forward to drilling into in coming weeks.
Governor, I now want to ask you about the balance sheet. In the previous October meeting, it was announced that starting on December 1st, the Federal Reserve would stop quantitative tightening, and the remaining mortgage-backed securities that would be rolling off would be converted into Treasury bills or would be replaced with Treasury bills. So the assets of the Federal Reserve balance sheet, I believe, is going to be held constant, with the liabilities changing, the reserves very, very, very slowly going down, being replaced by cash and other Federal Reserve liabilities. That is my paraphrasing of Fed Chair Powell speak. How are you assessing that strategy? It's very clear you're a dove on interest rates. Are you a hawk on the balance sheet?
So this is bringing me back to what we recorded about a year and a half ago, right, with Nouriel Roubini on relations between the Fed's balance sheet and Treasury issuance, and the way that the provision of those various risks into the economy can affect the stance of policy. And that was a really fun podcast that we did a year and a half ago. And thanks again for the opportunity to do that. I guess the way that I'd put it is this. What I think is interesting about what's occurred with balance sheet policy recently is that normally you would think that we're running down in a period of QT, we're running down our balance sheet. And that means that policy is incrementally more hawkish, more restrictive than it would be otherwise. The reason is because if the Fed owns a certain amount of credit risk through MBS or duration risk through MBS or longer tenor Treasury securities, and it ceases to roll over the securities, then when the securities get rolled over by redemption and reissue by the Treasury or the private sector mortgage borrowers, the reissued securities have to be absorbed by the market. They have to be absorbed by investors, which means that the amount of risk supplied, either credit risk or duration risk, supplied to the economy, to the investor community, has increased. And of course, we all know that if supply, if the supply increases, then the price goes down, which is just another way of saying that yields will move higher. It's supply and demand, right? And so normally you would think that allowing our balance sheet to run down through QT is an incrementally restrictive thing to do. The flip side of that is normally one would think that ending balance sheet runoff would then be an incrementally accommodative thing to do, because it removes that restriction. The reason that it would normally be incrementally accommodative is because when you stop runoff, and historically in the past this has often occurred, you just roll over the securities that you have and replace them with new securities of similar type. Now, what's happening now is that the MBS that are continuing to mature will be replaced by Treasury bills. Mm-hmm. And what that means is that even though the balance sheet runoff has declined, when those MBS mature and are then reissued by borrowers because they refinance their loan, or because they've sold their home and moved to another home, and so therefore the old mortgage is being prepaid, and the new mortgage will then be issued into the market. And so when those old mortgages are prepaid and the new mortgages come into existence and are sold into the market, they're not bought by the Fed at that point. They're bought by the public. And so even though our balance sheet is stopping runoff, because we have to provide a certain amount of reserves into the banking system to allow the banks to function under the regulatory code that we've established and that Dodd-Frank has established, the market is still having to absorb that additional credit risk and duration risk from the mortgage securities rolling off the Fed's balance sheet and then rolling onto the public's balance sheet. And so as a result, we've ended our balance sheet runoff, but we haven't ended the reduction in credit risk and duration risk that we hold through these maturing mortgage-backed securities. And that credit risk and duration risk is still being channeled back into the public through the fact that we're reinvesting those redemptions into bills instead of into the same types of securities. And so normally one would think that balance sheet runoff is restrictive, ending balance sheet runoff is accommodative. The most recent move does not fit that pattern, though, because the duration and credit risk is still being forced to be absorbed back into the market by the fact that we're not going to be buying it. And so it is the case that restriction still exists. And I think this is a bit of a potentially counterintuitive thing that has sort of not received the amount of attention that I would have expected it to receive. And I think it's an important point. And so I think it would be a mistake to have interpreted what we did with the balance sheet as being dovish. I think that actually it actually sort of reinforces that restriction is from the balance sheet runoff is still being transmitted into the economy through credit markets and interest rate markets, and that has not changed. Now, you asked before, am I dovish or hawkish on the balance sheet? I mean, I think that it's important to sort of keep the items a little bit separate. We have to do on the balance sheet what we have to do for the banking system, right? If the banking system requires a certain amount of reserves in the system to function, you have to provide those reserves. You cannot provide them and not allow the banking system to function as a result of that. Now, that doesn't mean that you don't analyze the effects of that reserve provision. You absolutely do, in the way that I just discussed a moment ago. And then you can think about those effects and whether that would make you change your outlook for interest rate policy and for the Fed funds rate. And so I do think that it's important to separate the issues. It's important to sort of separate why you have the size of the balance sheet you have from banking reasons, and then to use the Fed funds rate to achieve the right level of monetary restriction or accommodation. And then they can affect each other for sure. But you wouldn't sort of start setting balance sheet policy you wouldn't start setting balance sheet size to accomplish a monetary policy outcome outside of extraordinary circumstances of the zero lower bound. You're doing what you're doing on the balance sheet for banking regulation purposes, and then you're doing what you're doing on interest rates for monetary policy purposes, and they can affect each other, but they each have their own goals, and those goals can be in tension, as potentially they are, sort of right now.
Thank you for explaining that. I think it's kind of in the name, quantitative easing or quantitative tightening. Quantitative is the amount of reserves, which are the liabilities of the Federal Reserve and the assets of the banking system. And then the easing or tightening is what is the Federal Reserve buying? What is it tightening? So even though the quantity of reserves the Federal Reserve is going to, on December 1st, start targeting that so the banking system has the reserves it needs. On the composition of the assets, those are going to be mortgage-backed securities, which have risks that the Federal Reserve is taking out of the private sector, converted into Treasury bills, which is not that really much financial easing at all. Some officials on the Federal Reserve, Governor Miran, want to go further. And they say, let's actually actively sell our mortgage-backed security portfolio and not just let it roll off, because the roll-off is going to take 30 years. And as you know, the coupons, the interest rates on the mortgage-backed securities are so low that prepayments, a lot of these people are locked in and not refinancing. Would you go that far and agree with some of your colleagues that maybe it's time to consider active sales of mortgage-backed securities?
So I wouldn't at this point, and I think that the primary reason why I wouldn't is because some of those securities are underwater, and I don't think it makes sense to realize those losses for the taxpayer. If you hold onto the securities over time, they get pulled to par, and so as a result, you end up not losing the money. I think if you realize those losses, you crystallize the entries on your balance sheet, and then you sort of leave the Fed with a hole in its capital position. And yes, sort of theoretically, the Fed can operate with any capital position it wants, but I think it's still an inferior outcome for the taxpayer and for the institution to permanently realize those losses when we can just wait and allow them to pull to par.
That makes sense. And I believe it's the case that it's not that as if the government immediately has to pay those losses to the Federal Reserve. It's just the Federal Reserve has to fill that bucket back up before it can start paying interest to the Treasury. I believe that's the case. And Governor Miran, you earlier said the Federal Reserve needs to make sure the banking system has the reserves it needs to function. How much of the Fed's decision to stop quantitative tightening on December 1st was driven by that need? And can you speak to the levels of potential stress in the funding markets that are evident today that have actually somewhat exacerbated? My numbers are, I'm sure, more delayed than your numbers, but there is secured overnight financing rates is double digit higher than where it should be. Even the Fed's funds rate, which is the official rate, the Federal Reserve moderates policy, probably 3 to 4 basis points higher than it traditionally should be. What's your level of concern here? And is there potential that the cessation of quantitative tightening might have to be before December 1st?
Yeah. So look, I don't think it does. So let me be clear. I actually supported ending and sort of doing these balance sheet actions immediately after the recent FOMC meeting. I in the same spirit of as I mentioned before, of not wanting to run risks that I don't have to run just because it's how things were previously. I would have been in favor of ending balance sheet runoff immediately instead of waiting till December 1. However, I think that waiting to December 1 is not that big a deal. I don't think you're running huge risks in doing so. Look, the fact that some of these short-term interest rate moves have occurred, and moves in the effective Fed funds rate and some repo rates and the reactiveness of these interest rates to volumes has occurred, tells you that you're transitioning from abundant reserves to ample reserves, and therefore getting closer to the neighborhood where reserves are too scarce. Now, the issue is that nobody knows exactly where that is, and so once you start to get inclinations that rate markets are start becoming responsive to swings in volumes and swings in reserve demand, then I think it's sort of time to stop and say, hey, okay, we got far enough, and doing additional reductions in the balance sheet isn't worth the risk. Because as an economist, I come to this with the perspective of, you want to do a cost benefit analysis. You want to think about the marginal cost versus the marginal benefits of incremental balance sheet reductions. Now, the marginal benefits of incremental balance sheet reductions are real, right? So you'd have a slightly lower interest on reserve obligations that you'd be paying on those reserves. It's of course better for the Fed to operate with as small a footprint in the marketplace and the economy as it possibly can, and so you'd be improving on that score also. But I think that from a marginal perspective of what's the additional gain from another few weeks or another few months of balance sheet reduction, I think that those actually are quite small in terms of magnitude. The marginal cost has now just potentially increased a lot because we've seen interest rates start to be responsive in a way that they weren't 6 months ago. And then the pace at which they've become responsive has actually been much faster than was the case in the previous episode of balance sheet runoff before the pandemic. And we don't know exactly at what point you go from that pace having been faster and from these rates being responsive to these rates becoming way more volatile or dashing all over the place, and what that does to short-term funding markets, how quickly that would force us into purchasing more for the balance sheet, how quickly it would force us into a U-turn, what it would tell us about the process. And so as a result, I viewed the marginal benefits of further reductions as being real but quite limited in magnitude, whereas the marginal cost of further reductions in the balance sheet are enormously uncertain. But the distribution of risks in terms of where it could go, it could have been bad in ways that could be difficult to predict. So it's known and limited marginal benefits from further reductions versus unknown and potentially large costs of further reductions. And so in my mind, that analysis indicated that it would have been better to just stop reductions in the balance sheet immediately. However, I don't view waiting a few weeks to December 1 as being an enormous risk that we're running in the way that I do of having monetary policy as restrictive as it is that we discussed before. And so it's a question of thinking about how big are these risks, where should things be, and then trying to get a handle on what are the things you need to move quickly on, and what are the things that you maybe don't have to move as quickly on.
Governor Miran, I want to ask you a question about central bank independence. I'm not going to ask a question about your views, because you have said many times that you will do independent analysis based on your own interpretation of the data, based on your own interpretation of the economy, and that's what you will do. That's all that you will do. That is pretty much an exact quote. So I'm not going to ask you to repeat yourself there, but could I just ask you for your framework and how you think about central bank independence in general, and the value, good or bad, that it has. And of course, I'm talking about the idea that a central bank should make decisions without direct interference from the government's political pressure or outside interests, and that this independence allows it a greater chance of achieving its goals in the case of the U.S. Dual mandate of solid labor markets and stable prices. So can you just share your general outlook of that principle?
Sure. So look, the Congress tasked us with pursuing stable prices and maximum employment. And that is what we pursue, and that is what we will continue pursuing. It didn't task us with pursuing other things with monetary policy. Now, I think what people mean when they say independence is important, or at least what I mean when I say it's important, is it helps us focus exclusively on stable prices and maximum employment. If policy is being set for a purpose that is not stable prices and maximum employment, if it's being set for a quirk of the political calendar or pet projects that emanate from political cycles, then necessarily it's being set for purposes that are not maximum employment and stable prices. And so as a result, performance will be inferior on those outcomes that are really what we care about, and really what people care about when they elected a Congress and representatives that legislated stable prices and maximum employment. And so if you take your eye off that ball, if you start focusing on sort of short-term political pressures or political goals that have nothing to do with that, then I think you're going to deliver worse performance on the economic outcomes that really matter, which again are stable prices and maximum employment. And so for me, it's of critical importance that the Fed, that every member of the Fed do what we do for those purposes alone, and not because of any outside influences. Now, I think in order for the Fed to be able to enjoy that independence and to be trusted by the public with that independence, we have to be viewed as non-political and not politically in the corner of any particular group of the political landscape or any particular constituency. We have to represent all Americans and to work for the good of all Americans. And I think that requires us to be assiduously non-political and assiduously nonpartisan. And I think that requires us to stick to our knitting on monetary policy and discuss and stick to our knitting as well on other issues that sort of fall into our purview that become excessively politicized. That means, I think, not going into dangerous political territory on things like climate, and sort of sticking to our core mandates as have been assigned to us by the Congress.
Governor Miran, thank you so much for joining Monetary Matters. People can find you on Twitter at Steve Miran. I think it's a fantastic thing that Governor of the Federal Reserve is on Twitter and posting and active. We'll also link your speech from, I believe, September 22nd, where you laid out in great detail your framework, and you were very transparent there. I do see, Governor Miran, that later on Friday, so I believe that is on the 7th, you are making a speech. Could you just give us a little bit of a hint? What are you going to be? What is the subject matter of your speech there?
Well, I'm really excited to be talking about on Friday about stablecoins and monetary policy and the connection between the two.
Thank you again, Governor. Thank you, everyone, for watching.
Thanks for having me. Great to see you.
Thanks for tuning in. Looking into REMX by VanEck? Head to vaneck.com/REMXJack to learn more. That's vaneck.com/REMXJack. Until next time.
Thank you. Just close the door.